So far, what you know, and some of you are actually doing trading in the actual stock market, and you have put your money at risk. So you have got more experience. But those who haven't traded in the actual stock market and just started the simulation in this course, you're just learning how that system works, how you can buy stocks and sell and put orders, and how you can find the value, and how you can do your research to find the actual value that you think is the appropriate value for a commodity or for a stock, and then you can trade it. But derivatives are a little higher level. So I would say, like, if the stock is a product, as you mentioned, Darren, then derivative is what you derive from the stock. So here's how it works. The definition is a derivative can be defined as a financial instrument whose value depends on or is derived from the value of other more basic underlying assets. Okay, so one thing, it is a financial instrument. So what do we mean by a financial instrument? Like, if you write a check for someone, that check is a financial instrument. If you have bought the stock of a company, that is a financial instrument. If you have bought a bond, that is a financial instrument. So in the same way, the derivatives are also financial instruments. And there are several types of derivatives that we will be talking about, but it's a financial instrument. It has a financial value. It may not have a physical value. It doesn't probably exist in the real physical world, but it has a financial value. The second thing, which is also very important, its value depends on the other asset, which is what we call the underlying asset. So if you are buying a derivative on Tesla, for example, then Tesla is your underlying asset, and the derivative instrument that you bought based on Tesla's stock is a financial derivative product. Now, there are several types of products. We're going to talk about that, and we'll be digging deeper into all of those products, and especially focusing on futures and options, as this course title is. So futures and options are just two types of derivatives. So the course is focused on only two types of derivatives. So we'll be digging deeper into those, but we're also going to talk about the other derivatives. Now, what could be those underlying assets on which you can develop a financial instrument that we call a derivative instrument? The underlying asset could be a commodity, like it could be a grain, for example. It could be oil. It could be gold, anything like that. Or it could be stocks. So as I mentioned, like Tesla, you can buy a derivative or sell a derivative product based on that stock. It could be bonds. It could be interest rates. Okay. And it could be currencies. So and also the market indices, for example, the S&P 500, or you hear NASDAQ is going up and down, and those indices. We also have derivatives based on those indices. So those could be the underlying assets. Okay, and when we develop a derivative based on those assets, whichever asset that is, the derivative's value will change with the value of the underlying asset. All right. Now, why do we need a derivative? Or let me give you an example so that we can be clear on how the derivative market works. So let me give you a very basic hypothetical example right here, and see how we can construct a derivative. In this derivative, like as I said, there are several types of derivative products, but in this example, I want to talk about a certain only a particular derivative product, which is what we call forwards. Okay, and forwards, by the way, is the most simplest of the derivative instruments. We call them forwards. Okay. So let's put it this way. We have a house right here, okay? And here's person A who owns the house. All right. And here's person B who wants to buy the house. Okay. Now, for some reason, either both of them or one of them is not willing to do the transaction right now for whatever reason. Okay. Let's say that I'm the buyer, I'm the B, and I want to buy it, but I don't have the money right now. I'm expecting a cash flow in 5 months, and I want to buy it. But what I want to do is I want to lock the price of this house. Okay. So we are right here at time 0 trying to enter into a contract, and that contract will be executed in 5 months. So that is month number 5. Okay. And we agree, both of the parties agree that, we will have this deal completed at a price of 500K. So that is the dollar value that we agree on, but we don't execute that contract right now. I don't buy it because I cannot buy it. I don't have the money. So that is one of the reasons that we cannot have the transaction right now. But both the parties agree that we will do the transaction at the end of the 5th month. All right. So what we have right now, we just entered into an agreement. Okay. So this is the agreement. Okay. And what do we have in the agreement? There are a few terms, a few conditions. One, A agrees to sell. All right. And B agrees to buy. All right. And next, we have the price. We also agree that the price when we do the sale transaction, the price will be 500K. So that is also agreed. And also we agree on the date. So we have specific terms for all of these things. We will be discussing those later. And the date is like, 5 months from now. Let's say just 5 means 5 months from now. Now, what is this? This is a piece of paper that we signed with these terms and conditions. And I agree to buy, and for example, Darren agrees to sell. All right. And we just signed this piece of paper. This piece of paper does not have any value as of now. We just entered into an agreement because Darren still owns the house and I haven't bought it. So the paper does not have any value right now. But we have agreed, and that is binding on both of us. Now, what happens is that the current market price, let's say the current market price of this house is 500K, and that's what we agree. And just to make it simple, let's say that after a month, when we have not yet executed the sales transaction, the price goes up to 550 after a month. Now, what happens? What if I want to sell this agreement to another person, C, for example? C comes, we have a C person. C comes and wants to buy this agreement from me because this is binding. And if I sell it to C, then Darren will have to sell that house to C. Anyone who is holding this instrument, Darren is bound to sell it to him. So am I going to charge something for this piece of paper after a month when the house price is 550?
Yes.
And how much do you think I should charge for this?
At least 50,000.
Exactly, fantastic. That's the exact thing. So I will be charging now what I have this agreement, which is a financial instrument. Let me call that financial instrument. And this is a forward agreement. And now its value is 50K. All right, 50K. Even though the house price is 550,000, the market value, but the value of the derivative instrument is 50K. That is what we say, like, the value of my forwards contract changed by 50K, but only because the price of the underlying asset changed. If there's no change in the underlying assets price, there will be no change in the price of my instrument. Let's suppose that in the next month, so this is month number 1 and month number 2. So in the next month, it comes back to 500K. What is the value of my financial instrument now?
0.
0. Fantastic. In the third month, let's say that the price went down to 400. Okay, what is the value of my financial instrument now?
Negative 100,000.
100% correct. Negative 100,000. So what does that mean for me? If I have to get rid of this instrument right now, I will have to pay 100,000 to somebody so that he can buy it, because it's now on my liability. I will have to buy this price at 500K in 5 months. And we're just 1 month away from that, and it is quite likely that the price will stay at 400K or something like that. And so if in the next month it goes down to, when we reach to the execution time, the price has gone down to 350,000. Now, if I still hold the contract, Darren will show up and tell me, hey, you know what? We have this contract. Give me 500,000, which we agreed on, and get the house. Darren knows that the market value is 350K. I also know that. And by doing that, I'm actually losing $150,000. But it is just because I had this agreement which had no value at the time of signing, but as time passes, its value changes. Okay, and so that is how we develop the derivative agreements. Now, instead of the derivative, if I actually buy the house from Darren at time 0, I actually buy it. That's not a derivative instrument anymore. I actually bought the commodity. I bought the house. Okay, so it's not a derivative. I actually hold it, and its price can still go down to 350. I know I'll still be losing 150K, but I have the asset right from the beginning. So in that case, I would be holding the actual asset. But in the previous example where we talked about this agreement, I was holding only a financial instrument whose value was derived from the value of the underlying asset. So can this simplify the whole story? Any question, comment?
I got a question now. Can you actually go ahead and, instead of the value going up, how about the value going down?
Well, so it's the market price, like it's the housing market, and the Fed is increasing interest rate, and you see like these days the housing price, the prices have started to go down, and there could be a big problem in the economy. Let's say a couple of banks go bankrupt, and we may have a situation like 2007-8 again, and there will be like a big dip in the prices. So I mean, like you never know what happens next.
I must say, can you do a derivative of anticipated going down?
So that is one of the reasons that we enter into these derivative agreements. That's a good question. Like if A agrees to sell this house to me at 500K, what A thinks is that the price is going to be less than 500K in 5 months. Otherwise, he wouldn't enter into this agreement, right? And I think that it's going to be more than 500K, and that's why I buy it. Now, who is right? That depends on everybody's research. And there are lots of unexpected events that are out of our control. And so those things can also be a big deal. So that is why we also use derivatives for hedging risk, for risk management. Okay, you never know. There's like a couple of banks go bankrupt in the next 2 months. The interest rate is still going up. You don't know what's going to happen with inflation, and all of those factors. So I have bought this house at, let's suppose I bought it, or it was Darren. Darren bought it at 450K, like a month ago. But Darren is just worried, like he thinks, well, the price may go down, it may stay like that. And if I am willing to buy this house from him at 500K, which gives him a profit of 50K right now, I mean, like it's going to be in 5 months, but that 500K profit is locked. He got it. And why does he enter into that contract? Because probably he thinks that it's not going to stay like that. Probably he's not going to get that deal in 5 months. Maybe the price is going to be 300K in 5 months or whatever. And I have a different perspective. Or maybe like, I actually need the house. Darren bought it for investment and wants a return, but I actually need that house. I like it and I want to buy it no matter what happens, but I don't have the money right now, So something like that could be the factors. So Darren is actually managing the risk. I'm also managing the risk. What is the risk for me? Why am I entering into this futures contract right now? One other thing, I may not be able to buy it in 5 months when I have the money. Maybe the price has gone up, so there's a risk price going up. Maybe it's sold and the next seller is not selling it. So, and this is what I love to buy. So in order to manage that risk, I just enter into an agreement with Darren to guarantee that I'll be getting it. Right? And so as I said, the derivatives are one of the simplest, or probably you would say is the most like the ones that the derivatives that came into market like the first. In the history goes like this. What happens, especially in the commodities market, like especially agriculture, is we need wheat, we need rice, for example, all those other agricultural products. But all of those products need about 6 months to be prepared, right? From sowing and prepare the land and harvesting. Now, if I'm a farmer and I harvest like I sow let's say wheat, but at the end of the when it's the harvesting season, there's lots of wheat in the market, and the price has gone so down that I cannot even cover my cost. So I'm losing a lot of money, and there's a risk involved. And so what's going to happen there? I will be losing a lot of money, and the next year I'm not going to be using my land for wheat. I will do something else, and probably everyone else is doing the same, because everyone else who had a wheat crop, they're not going to grow wheat that much, so they're shifting to another product. So what happens in the next season? Because there are very few people who have the wheat crops, and there's a shortage, the next year the price is going to go up. Now, it's a bad deal for those who are like, for example, if I have a bread factory and I have to produce bread and the prices have gone up so much, it's making my business at risk. So what happens, in order to guarantee those price fluctuations, what we do is at the time of sowing, preparing the land, me as the farmer and the factory, the bread factory owner, enter into an agreement. Hey, I'm gonna sell 100 bushels of wheat to you at whatever price, $50, $100, and you're gonna buy it from me no matter what happens to the market price. What is the thing? Now, for me as a farmer, I'm at peace. I don't have to worry about the price fluctuation. And you as the factory owner, you also enter into that agreement. So yeah, that is one of the things that you can do. The airline companies, especially, they have lots of those kinds of forwards and futures agreements with the oil producers, because the oil prices go up and down. And that the airline industry just wants to not to give like lots of surprises in terms of prices to its customers. They keep like a steady pricing. How do they do it? They one of the major variable for them in terms of determining the price is the oil price, because they consume a lot of that. And so they guarantee the future prices through these types of contracts. So they are actually managing the risk. All right. Now, let's dig deeper. So Why do we need derivatives? I think we just talked about some of that. So hedging risk. So like price going up or down for a farmer, I have a risk. Maybe I might not be able to sell it at a good price. And as a factory owner, factory owner, he's worried that he may not be able to get the wheat at that certain price. So we both actually are in the business. We both are in the business and we are facing a real risk and we want to minimize our risk. And that's why we enter into the forward contract, for example. It is also used for speculation. So what is speculation, by the way? What do we mean by speculation? You hear this term a lot in the stock market. What do we mean by that? Anyone? Any idea? I mean, doesn't have to be, you don't have to be correct. Just say something, whatever you have in mind.
You want to purchase something, you're hoping that the item you purchase gets higher in value later on, so you go ahead and sell it later on for profit.
Correct. And the actual thing here is that I actually don't need the product. I'm just that is the actual definition of the of speculation. So like, for example, if Darren is the bread factory owner, and I'm sorry, but I'm giving Darren's example every time because his camera is on, so I see him. So it's not like, just bear that in mind. Darren is the factory owner, and I'm the farmer. So we both are actually facing an actual risk of price fluctuations. It is actually affecting our business. If the prices go too high, Darren could be out of business because of those high prices. And if it goes too low, I can be at a very high risk. So we are trying to hedge our risk. However, there's a third person. Who can be the third person? Let's say Chandler. Okay, so Chandler does not have any farming business and he does not have any bread factory. He does not actually need the wheat, but he thinks that the price is going to go up. Okay, for whatever reason, he has done some research. He thinks that, the weather is going to be bad this year and there will be floods, for example, and there will be limited wheat production. So the price may go up and he actually does not need it, but he buys a futures or a forwards contract from me, from the farmer, to buy, like, let's say 1,000 bushels of wheat at a certain price. And he probably turns out to be right. And the price goes up, it doubles by that time. So he is earning a lot of money. And even then he doesn't need the product. So what he does, he can either sell the forwards contract to someone else at that time, or buy the actual, get hold of the actual commodity and sell it later, whatever he may want to do it. But he, as a speculator, he would never like to have the actual commodity. He would like to get rid of the derivative instrument before the expiry, before the actual delivery date. So those are speculators. So speculators use it for expected future price movements. Okay, we can also have leveraged position. So we'll be talking about this later on when we talk about futures and options. But what we have here is that when you do derivatives trading, you can buy a big amount of the derivative instruments with little of your own investment. So you can be investing $10,000, but the market gives you the opportunity to use the $10,000 and buy a derivative instrument which would be worth like $100,000. So by investing only 10,000, you're buying 100,000 worth of assets. So that leverage gives you a lot of benefit if the price moves in your favor. But it can give you a big loss, like you can be wiped off your $10,000 in a day, overnight, if the price has if the commodities price moves against you and there's a big movement. So you can be out of your position in it. So you are actually, by leveraging, you are getting a huge benefit if the price moves in your favor. But if it goes the other way, you can face a huge loss. And we also use it for portfolio diversification. So all of these investors, they would like to have a piece of everything so that the risk is diversified. So a piece of stocks and a piece of bonds and in currencies, in gold, and probably some commodities, and also some derivative instruments in order to have a diversified portfolio. Now, these are the few types of derivative instruments. The one is forwards contracts. So we'll be just skimming through the forwards contracts, but most of our discussion is going to be on futures and options. So the second and the third one, because that course is based on this. And then we also have swaps, which is mostly used in the foreign currency transactions, and especially if you have business abroad and you sold something. But we'll have a little bit of discussion on that later on. And structured derivative instruments are actually a combination of different, like, you combine some swaps and some options and some futures and create a complex derivative product. Now, in all of these products, especially, they move up in terms of complexity. So as I said, forwards are the simplest ones and very easy to understand. Futures are a bit more complex. Options are, further complex. Swaps and structured products are the most complex, I would say. So before, entering into any of these contracts, please make sure that you understand it. And for that matter, like the whole stock market and the bonds market, if you don't understand the dynamics, don't risk your real money, because you can be, you can be out of your savings pretty quickly if you don't understand the dynamics, and especially the derivative products. So what are the few other things that are related? So leverage risk, as I said, like, we just discussed, you can, with the leverage, I mean, like with $10,000, you can buy instruments of $100,000, which can give you a high return, but it can also give you significant losses. So leverage is one of the things. Counterparty risk is another element here. So what is that counterparty risk? Can somebody explain it to me? So let's see, Marcus has also joined the class. Thank you, Marcus, for joining. And who else? Okay, the rest is the same. Okay. What is counterparty risk?
Does it mean that you have one of the parties defaulted or decide did not want to obligate, if you did want to honor the contract?
Correct. Fantastic. That's the exact thing. So let's go to this example. Can you see my Word file that I drew on?
Yes.
So let's come back to the same example. It's me and Darren, and I am the buyer of this contract, and the price has actually gone down to 350K. And it's a big loss for me if I buy it, because I'm bound to buy it at 500K. But now the price has gone to 350K. I'm losing $150,000. What if I just disappear? What's Darren gonna do? He's gonna sue me. He has got a contract, and probably he has got my information, so he's gonna sue me. But lots of trouble. So especially in the forwards contracts, which are not actually standardized and they are not traded on the exchange, so there's no other person who is taking the responsibility. It's just an agreement between two persons, and maybe individuals, maybe two institutions. And if it's a big loss for one, they could disappear, or maybe, like, I don't want to disappear. I still want to buy it. As I said, I like the house and I love it and I want to live in it. But when we are at the end of the 5th month and it's the time to execute the contract, I still don't have the money. My cash is still stuck somewhere, and I'm still not in a position to buy it. So what happens? I mean, like, there's a big risk at that time for for Darren. So that is what we call the counterparty risk. But remember that this counterparty risk is on the, especially in the case of the OTC products, and the main OTC product is the forwards. The other contracts that we talked about, we are pretty secure on that. So the counterparty risk is pretty limited because those are traded on the exchange, and the exchange has its own arrangement to manage the counter. Even if the other party defaults, there's like, the system will be talking about that. They're not going to defaulting in that way, but even if it does, the exchange is taking the responsibility. But for forwards, and the simplest example that we just talked about, the counterparty risk can be very significant. And also, you need to consider the complexity of the risk and complexity of the derivative instrument. So I would say if you don't understand it, if you don't really know how it works, don't risk your actual money. And that's why we have this simulation exercise so that you can see how it works, and how much you can make money if it moves in your favor or if it moves against you. But don't risk your actual money if you don't really understand the derivative products. And also the market risk, of course, the market risk is actually applied to the actual commodity on which the derivative is based. So for example, the Tesla stock or the house that we just talked about, there could be a dramatic shift in the market conditions. And so that is also a risk that is because it affects the actual commodity, and the commodity affects the price or the value of the derivative. So we need to keep those things in mind. And the last thing who regulates derivatives markets. So in the US, we have the CFTC, the Commodities Futures Trading Commission, and they are regulating most of the derivatives in the market. They are trying their best to maintain transparency in the market in terms of the instruments and in terms of the buyers and sellers, and providing like a little bit of safety and security to the investors. Because they have their own reporting requirements. If you are listing a derivative instrument, you have to meet certain reporting requirements. If you don't meet those, they don't allow you to be for that derivative to be listed and traded in the market. And also they try to maintain the market integrity so that there's little manipulation. Manipulation still happens at a lot, significant scale. We'll be talking about those in some future lectures. But yeah, what the regulator does is that they're trying to minimize the manipulation in some unfair practices. And those things still happen. Those frauds, like you might remember the Enron frauds and some others, like there's still lots of things going on in the market. But the regulators are just trying to minimize those risks to a little bit of extent and provide a little bit of security to the investors. So I think that's it for today. Just a teaser of what to expect in the second half of the term. But we are available anytime. I'm insisting this again and again. It is a teamwork and we have to make it a success together. Every one of you matters. Every one of you is important, and your problems are important to us and they are our problems. So we are here to resolve any issue that you might be facing, any concern. I mean, like you might be just worried about something and you feel overwhelmed or just, need a little bit of counseling, just let us know. We'll talk. We'll work it out. Okay. If there's any question right now, please go ahead and please, Darren.
In one of your assignments, there were like two articles that we had to read. One was what is the stock, and one was like, I think it's like a ticket marker.
Mm-hmm.
Where do you find those articles? Or do you just look up an article?
So you mean they are not available?
There was two articles. There was like, I think like maybe exam 2 or something to do with number 2. And you had to read 2 articles first, then answer questions based upon those 2 articles.
Okay, so what I've done is that I have made all the resources available to you. So you don't have to look for a resource outside of the link. So all the links are provided. You just need to follow the links that I have provided in your modules. But if still there is any mention of any article or something that is I mentioned and it's not available in the given resources, please let me know, send me an email, and I'll find it and share it with you. But you don't have to look for any resource other than the material that I have provided. If you cover, like, honestly speaking, if you cover the material that we have provided, you will be in a completely, new position to enter into the trading market after you finish the course.
Okay.
All right. Thank you. Any other question, comment? Nope. All right. So
Yes,
we're
sir. I have
good
a
to.
question.
Oh, sure, Marcus.